Welcome back to REIQA.com Real Estate Education Program. Be sure you started with the welcome video and have already completed sections 1 through 15. In section 16, we will discuss multifamily investing. Please subscribe to our channel, like this video, and ask any follow-up questions in the group. Our experienced investors will respond throughout their days to help you. Check out our website at REIQA.com and the links in the description below for more real estate help, tools, and resources. Now, let's begin section 16. Multifamily apartments. This is the dream and where freedom numbers and retirement are earned. We all want to end up with a portfolio of buy and holds of some type. We typically start off with single family and eventually either acquire a large portfolio of single family or transition into multifamily. I caution you to grow your experience and capital at first in the single-family market. The buy and holds will happen as you run across motivated sellers willing to sell or finance deals, and eventually after you build up more experience and some of your own capital and get private lenders and banks willing to lend to you, then you can consider transitioning your focus into multifamily. Too many people get into buy and holds based solely on the cash spread between the payments versus the rental rates, and later find out there's a lot more expenses they must factor into buy and holds. You have the mortgage payments, plus insurance, property taxes, management, advertising, basic repair and maintenance, large capital improvements, possibly utilities that are not individually metered to tenants, and other costs. This is also where multi-units are better because the cost is spread across multiple units or doors. If your single-family rental is vacant, you lose 100% of the rent revenue coming in. But if you own a 10-unit apartment complex and have a vacancy, you're only losing 10% of the rent revenue. That's a huge difference. Multifamily real estate refers to properties that have more than one housing unit, like apartment buildings, townhomes, and condos. Although multifamily is technically anything with 5 or more units, many of the same principles also apply to duplexes, triplexes, and quads, especially starting off. Those may be your first step towards moving up into owning apartments. When considering investing in multifamily, it's important to think about: first, how many units can you afford to invest in based on your budget and financial situation? Next, what about the location? Is the property in a desirable area with a lot of jobs and good schools? What's the neighborhood and comps like? Are the other similar properties at full occupancy, or are there a lot of units available for rent? Next, what about the property condition? Is it well maintained and updated? Or is it a value-add property? Is there potential for rent increase based on an up-and-coming area or by improving the property? What's the current numbers look like, and what's the potential after upgrades and rent increases? Will the property generate enough cash flow? Once you locate a potential apartment deal, you'll need to run your numbers. You'll need to estimate the potential rental income. Start by researching the going rate for similar-sized apartments in the area. A good place to start is by searching the current fair housing rates for the area. This can be located on the Department of Housing and Urban Development, or HUD website. They list them by year, county, and city. Also, check current rental listings on sites like Zillow, Trulia, Apartments.com, Craigslist, and Facebook Marketplace. Rentometer is another site to help estimate the rent rates. Make sure to take into consideration all of the following. What utilities are included? Is there laundry in units or on site? Is there off-street parking? Is the property upgraded? If it needs work immediately, what's your repair budget? Next, you'll need to know the current expenses, occupancy status, and rent rates. You can usually get all this from the current owner or their broker, realtor, if they have it listed with one. You'll need the rent roll and P&L, or profit and loss statement. This will show you all the actual numbers. You may be asked to sign a non-disclosure in order to get this information. The rent roll shows you how much rent each tenant owes each month, and if they're paying or not. This will include a unit breakdown with occupancies, vacancies, lease terms, rent amounts, collected rents, default rents owed, and late fees. The P&L shows the current expenses, including both variable and fixed expenses. Variable expenses are expenses that change, including advertising, pest control, lawn care, utilities, property management, legal fees, repair and maintenance, capital expenditures, etc. Whereas fixed expenses are those that are the same and do not change during a 12-month period, like taxes, loan payment, insurance, etc. Once you have the information, you can run your numbers based on the current status and the potential status if you can improve the property by doing improvements or by managing it better. Let's look at a sample apartment deal. This is a 16-unit complex I evaluated several years ago when I first started. My plan here was going to be doing some improvements to the outside of the complex, power wash the bricks, siding, windows, and parking lot, new paint where needed, some landscaping, paint new parking lines, paint the sign, etc., to give it more curb appeal. By doing this, I would be able to increase rents by 15%, which would put it right at the market rents at the time. Then, as units turned over, we would do any needed interior improvements to each unit also. But after seeing their current numbers, when including all expenses, it was barely cash flowing $100 a month per door. And after running my analysis shown here, even after increasing rents 15%, at full occupancy, it would still only cash flow around $2,700 a month or $170 per door. That just wasn't enough for me, especially knowing I would have to wait for tenant turnover to be able to do interior updates to help get it to that point, and have close to $100,000 of my own capital tied up in it. So I passed on the deal. But this gives you an idea of what all you should be figuring. Now, let's look how lenders evaluate apartments and other commercial properties. When financing apartments, a lot goes into it, but for the most part, lending institutions will look at the NOI and expenses to determine the DSCR, and based on the property's purchase price and sometimes recent comps, will determine the cap rate. Now, let me explain what all that means. NOI is net operating income and is a calculation of the income generated by a real estate investment. It measures the amount of cash flow generated by an investment property after operating expenses, but before principal and interest payments, capital expenditures, depreciation, and amortization. DSCR is the debt service coverage ratio, which is the ratio of cash available for debt servicing to interest, principal, and lease payments. For the majority of lending institutions, they are seeking a DSCR of between 1 and 1.5. Cap rate, or capitalization rate, is simply a formula. It's the ratio of a rental property's net operating income to its purchase price, including any upfront repairs. So, to recap, cap rate equals net operating income divided by the purchase price. Some other things lenders will consider include credit score, down payment, and cash reserves. By now, all these numbers and acronyms we've touched on may have you feeling overwhelmed. The great thing is there are now many great tools available for running your numbers, so you just need to understand the concept of it. You'll learn more as you start evaluating apartments. We use the Deal Check app for all of our evaluations, no matter what strategy the deal may be. There's a link below this video and on the REIQA.com website to get a free basic version. That concludes this section. I know we covered a lot of information in a short amount of time, but this video is just a general overview of multifamily. In the next section, we will discuss short-term rentals. Please subscribe to our channel, like the video, and ask any follow-up questions in the group. Our experienced investors will respond throughout their days to help you. Check out our website at REIQA.com and the links in the description below for more real estate help, tools, and resources.